Hi friends, very good evening all of you. How are you? I hope all of you are doing great. Welcome back to CAP classes. Today we are going to start a new batch for CA intermediate students who are writing exams in 2023. So this is for both May 23 and November 23 students. So this is CA intermediate paper 1 accounting. So put the heading ACCOUNTING. In this, we'll start with accounting standard 2, accounting standard 1, this basic that accounting policies and all fundamental accounting principles. I'm sure you might have read the theory so many times. So because it is purely theory, I do not want to start with that. Accounting standard 2 includes a lot of calculations, problems and logics also. That is the reason we'll start with AS2, but 100% syllabus will be covered. Even all the theory will be discussed. We'll go back and we'll discuss AS1 also. Today, let us start with AS2. What is AS2? What is AS2? Is it valuation of inventory or inventory valuation? Valuation of inventory. Valuation of inventory. Guys, literally, this particular standard, if you ask me to teach for 50 hours, 50 hours, I can teach you this. Okay, because the standard is wide. And you look at ICI study material, normally I respect ICI, normally underline. Okay, I respect ICI and I'm a dedicated member, dedicated student. So whatever the boss says, boss is always right. I am that kind of person. ICI is always right. I am that kind of person. But when you read any accounting standard from CA intermediate textbook or CA final textbook, any accounting standard you read, there is 99% chance that you will get a panic attack, you will get a heart attack, or you will start rethinking, will I be able to master accounting standards in my whole life? I do not have hair, but if you have hair, you'll catch your hair, you'll pluck it and you are like, what is this? But trust me, actually accounting standards are very simple. Actually accounting standards are very simple. But you know, the language we use, the vocabulary we use, what we call typically the jargon or the nomenclature or the construction of sentence is such that many a times you'll not understand what it is. You'll not understand what it is. Okay, so now look here. This is our beautiful ICI study material. So chapter 3, unit 2, 3.38, valuation of inventory, AS2 revised. Okay, so this is starting in page number 3.38. You can see page number 3.38. Okay, move on. Introduction, inventory. They have given definition, which is LKZ definition. What is inventory? Obviously, inventory is something which is held for sale in the ordinary course of business. Simple. Inventory is something which is held for sale in the ordinary course of business. That is finished good. Pavan sir, it can be raw material also, obviously. Pavan sir, it can be work in progress also, obviously. So look at the definition. AS2 defines inventories as assets held for sale in the ordinary course of business. Okay. In the process of production for such sale, what is this? Work in progress. For consumption in the production of goods or services for sale, what is that? Raw material. So bottom up, study from third bullet point to first bullet point. Third bullet point raw material, second bullet point work in progress, first bullet point is finished goods, correct? And it also includes certain supplies. Certain supplies, like some indirect materials held for repairs and maintenance, or stores and spares and accessories and loose tools and all. Obviously they are also inventory. Okay, so read this: for consumption in the production of goods or services for sale, which means raw material, including maintenance supplies. Okay, consumables. Okay. Other than machinery spares. Why other than machinery spares? Because if you read AS10 carefully, certain machine spare parts are eligible to be capitalized as a part of property, plant and equipment. I'll give you a small example. In your classes, whether you are attending, graduation or any professional course, in classes nowadays, in every class you will see what do we call projector, isn't it? So these projectors are costly. So some nice projector, see, projectors are available from 5,000, 10,000 also, I know. But professional, good quality projector and all will come in 2.5 lakh rupees. Okay. So this projector has one lamp inside it, bulb, which is actually very costly. So if you are looking at a projector whose cost is 2.5 to 3 lakhs, the lamp could cost 40-50,000 easily. So projector life can be 2 years, 3 years or 4 years, but the lamp's life can be 1 year or 1.5 years. So when you went to the shop to buy this, the dealer told you, hey bro, why don't you buy one spare lamp also? Because anyway, this will work for 4 years, that will work only for 2 years. So you need one extra lamp also. You said, no, that lamp I'll buy when it is required, not today. Then he said, hey, listen. Normally the lamp cost is 50,000, but if you are buying that along with this, I'll give you only for 20,000. This is how they do marketing packaging. Now you are thinking of, anyway I need this. Instead of putting 50,000 that day, why can't I spend 20,000 today? Chalo, give. So 2,50,000 for the machinery, 20,000 for the spare. Under some circumstances, based on satisfying certain principles, accounting standard 10 says these kind of spares can be capitalized. That is the reason, because it is falling under AS 10, AS 2 said other than machinery spares. So if there are machinery spares which meet the definition of PPE, Pavan sir, this machinery spare failed meeting the recognition criteria, meeting the definition of PPE. So if it is not allowed to enter AS10, it has to come to AS2 only. So now when you buy spare parts, when you buy accessories, you have to check whether it has met the definition criteria of AS10. If yes, include that in the cost of property, plant and equipment. If not, that will become inventory. Simple. So this is clear. Definition is clear. Now, after that they will tell you exclusion. Obviously, some commercial, some construction is there. Some construction is going on. Okay, Pavan sir, my intention is after completing this building, there will be 100 flats. I will sell the flats. Okay, I started constructing this as a part of a construction contract. I am contractor. There is some other person, contractor, contractee, 2 people are there. In a situation where you are not constructing it for yourself, you are not constructing it for sale, you are constructing this building under a contract for some other contractee. If that is the situation, you have to apply accounting standard 7. You cannot apply AS2. You cannot say work in progress. That is work in progress. But what work in progress? Capital work in progress. Either that will go to accounting standard 10 if the asset is for you, or it will go to accounting standard 7 if the asset is for a contractee. Simple. So work in progress when you are constructing a building or a dam or any physical construction which falls in AS7 will not come in AS2. Common sense. Clear. Next, work in progress arising in ordinary course of service providers. You are a service provider. Okay. In this situation also, you will not apply AS2, because when you are, say, developing a software, you are developing a software to be sold to some party, you apply accounting standard 26. Intangible asset, you are developing an intangible asset that will be held for sale, but today it is not ready. So even work in progress arising in the ordinary course of service providers also, you will not consider here in AS2. They have given one example in case of shipping company, fuel and stores are not consumed at the end of accounting period is inventory, but not cost for voyage in progress. See, I'll tell you one thing. Students will be damn confused and they will break their head. Pavan sir, what all these things are? See, actually speaking, in these things, nothing is required. But because it is given, sir, that is there in material, no. If I study, I will not understand. No. This is the only bloody reason we'll have to discuss all these things which are actually not required. Now try to understand. There is a construction contract. For that construction contract, you have purchased 100 bags of cement. This 100 bags of cement is not yet used in construction. For that 100 bags of cement, you apply AS2. For the building which is under construction, you will not apply inventory standard. But you have some materials in hand. Okay, you have cement bags, you have iron rods. Okay, you have bricks. For all these things, you will apply AS2 because they are raw material only. They are not capital work in progress. No. Similarly, there is one vessel which carries goods and passengers from one country to another country on high seas. You are starting in, say, for example, Chennai airport, and you are going to, say, for example, London. Chennai port. Okay, in a vessel, ship. In that ship, on 31st March, the ship is, say, somewhere in the middle. It has not yet reached London, it is not in Chennai. Somewhere in the middle. So service provider, service is work in progress. For that, can I apply AS2? The answer is no. But Pavan sir, in that ship, 2,500 barrels of fuel is there. Can I apply AS2? The answer is yes. Because that is raw material. That is not service in progress, no. Are you getting my point? That is not service in progress. That is raw material. Say, for example, in the same ship, they have, certain food items, like, for example, there can be wine, there can be cigarettes, there can be some food items, there can be some packaged food items like, this nachos or Doritos nachos or Lay's chips or Pepsi. All these are raw materials. Either you can say raw material or you can say inventory. Finished goods ready for sale, trading. Okay, for trading. For all these things you apply AS2. Only for the voyage in progress you will not apply AS2. But actually student need not know all this nonsense. Then Pavan sir, I purchased shares and debentures. My intention is to hold them for sale. I am sure I am not going to hold them in the long term. Can I consider them to be inventory? No, don't apply AS2, apply AS13. Why AS13 is a specific standard for that. Okay, similarly, agricultural produce, forest goods, livestock, for these people, there is another standard called Ind AS 41, agriculture. Okay, so if you are a farmer or if you are a poultry, Pavan sir, I am running a poultry, I have many birds, I have many animals. You will not apply AS2. Okay, you will apply a different standard that can be, AS10 or that can be Ind AS 41. These are exceptions. Now, I'll tell you something. Look here. Oh my gosh. Okay, so much of theory. Even, cost of construction. They will explain you in 100 lines. Inclusions, exclusions. Now. This disclosure, all these things. Now, today we'll do one game. Okay, we'll do one game. We'll not read the standard. I'll come back and teach you the whole standard. We'll not read the standard. Let us see whether we'll be able to solve the problems or no without reading the standard. If we have common sense. Do you have common sense? Because nowadays common sense is not common. Common sense is not common. Everybody is not having common sense. That is the biggest problem now. Look at social media. Look at, YouTube comments. You understand that people do not have common sense. Okay, but chalo, whatever it is. Do you know one basic rule without reading AS2? Did you do AS2? No. AS2? No. You have not read AS2 till now. Do you know that inventory is to be valued at cost or net realizable value, whichever is lower. Have you read this? Inventory, write down, inventory is to be valued at A cost, B net realizable value, whichever is lower. Correct? This is the rule. And there is a big discussion on how, see, what is inventory, what is value, what is cost, what is NRV. All these things are explained in 100 pages. Ignore. Let us see, do we understand this? Are we able to solve the problems? Let us see. So straight to go to problem number 1. Straight to go to problem number 1. Let us see whether you are able to understand this or not. The company deals in 3 products, okay, A, B and C, okay, which are neither similar nor interchangeable. That means they are different, they are not same. At the time of closing of its account for the year 2021-22, the historical cost and net realizable value of items of closing stock are determined as follows. Okay, so they have given a table. Read the table. Read the table. Now the question is, because there are three items, Pavan sir, shall I add the historical cost of all the 3 items, net realizable value of all the 3 items, then do I do cost or NRV, whichever is lower, or A, cost or NRV, whichever is lower, separately, B, cost or NRV, whichever is lower, separately, C, cost or NRV, whichever lower, separately. So do you want to group ABC into one item and then total cost, total NRV you want to compare, or you want to do it item by item? Simple, use common sense. They clearly said they are not interchangeable, they are not similar, they are not same. When they said that the nature is different, how can you group them? You cannot. So you need to see A, whichever is lower, separately, B, whichever is lower, separately, C, whichever is lower, separately. Okay, so cost NRV 4028, A, cost NRV, inventory value 4028, whichever is lower, 28. Simple. 40, 28, 28. Then 32, B, cost 32, NRV 32, whichever is lower is 32 only. C, 1624, C, 1624, this is 16, correct? And now you add this 3. This is inventory value for your balance sheet. Inventory as per accounting standard 2, which will go to your balance sheet. So how much it is? 8 and 2, 10, 6, 1, 1, 2, 3, 4, 5, 6, 7, 76. So you cannot add this 3, you cannot add this 3, and you cannot compare cost or NRV, whichever is lower. You need to do it item by item. Read the answer. That is what they are saying. Hence closing stock will be 76. So you cannot say 88 or 84, whichever is lower. No, that is wrong. They should not even have totaled this. Why the hell they have put 88, 84? That is unnecessary headache. You should not. Why you are adding ABC cost? You should not. So 76 is the value. Simple. Problem number 1 is over. And you did not read any accounting standard. Without that, your common sense said. Now, illustration 2. Again with common sense. Again with common sense. X company limited purchased goods at the cost of 40 lakhs in October 2021. Very good. Till March 2022, 75% of the stocks were sold. That means your common sense says remaining 25% is inventory. So inventory, cost of inventory is 40 lakhs into 25%, 10 lakhs. So can I say problem number 2, A cost is equal to, you bought 40 lakhs worth of goods, in that you sold 75%. So remaining 25% is inventory, correct? That is cost. B, the company wants to disclose closing stock at 10 lakhs. Very good. The expected sale value is 11 lakhs. Oh my god, why expected sale value is given? Common sense. Net realizable value is the expected sale price minus incidental expenses to sell. Correct? That is what realizable value means. Realizable value means at what price I can sell it. Net realizable value means at what price I can sell it minus expenses. So they said, expected sale value is 11 lakhs and commission 10% on sale. Okay. So B, net realizable value, NRV. How to calculate NRV? Under that, expected realizable value 11 lakhs minus sales commission, less commission, 10%. So what is 10% of 11 lakhs? 1,10,000. So net realizable value how much? 9,90,000. So this is net realizable value, this one. This is net realizable value, this is cost. Now you tell me what is inventory value. The problem is over. Cost or NRV, whichever is lower. So inventory value is 9,90,000. In the problem, they said that the company is willing to show inventory at 10 lakhs. Now you will write the contention of the company is not correct. They cannot show inventory at 10 lakhs, which is the cost. They have to show inventory at cost or NRV, whichever is lower, which is 9,90,000. Clear? So for this, do you need accounting standard 2? No, common sense. With common sense, you are able to do problem number 2 also. Then problem number 3. In a production process, now you have not studied accounting standard 2, but do you remember in your foundation or in your +1, +2, 11th class, 12th class, in your degree, somewhere you have studied the concept of normal loss and abnormal loss? In consignment, in joint ventures, in so many things you have read what is normal loss, what is abnormal loss. Okay, so basic common sense, the cost of normal loss should be included in the value of inventory and abnormal loss should be charged to P&L. Okay, even in costing also it is same. So when you are speaking about loss, process loss, there are two types of losses. Normal loss, which cannot be controlled, abnormal loss, which can be controlled. So this is inherent, uncontrollable. This is controllable. That means this happens due to the recklessness, carelessness, inefficiency of people. This happens due to recklessness, carelessness, inefficiency of people. For your recklessness or inefficiency, can you say that, Pavan sir, I want to pass on this cost to my customer? Is it possible? The answer is no. Customer will kiss you with left shoe. Customer will kiss you with left shoe. Customer will ask, idiot, your inefficiency, your recklessness, why will I bear the loss? You cannot pass on this. Then Pavan sir, if this is the case, what to do? This is your loss, you need to charge to your P&L. You will bear it. You will bear it. You understand? This is situation 1. Situation 2, Pavan sir, can I pass this loss? Can I pass this loss to customer? Happily you can. Customer will pay. So there is no accounting standard here. This is common sense. I'll tell you. I'll give you 2 examples. One, go to a juice shop. Go to a juice shop. Okay, you have ordered for a milkshake, or you have ordered for pineapple juice. Okay, or banana juice. You have ordered for some juice, mango juice. Okay, now for you or for me, I am the customer. For me, you consumed you consumed 1 kg mango. For example, to fulfill my order, you consumed 1 kg mango. So you went to the shop, Reliance Fresh, you bought 1 kg mango with 100 rupees. Okay, mangoes you bought 1 kg for 100 rupees. Okay, now you came, you are fulfilling my order. I am looking at you. It is a live kitchen. Okay, in front of my eyes, you are doing that. So you washed the mango, you started cutting mango into pieces. Okay, in between, big nut will be there. Can you put that also in juice? No, you have to remove that and throw now. So you peeled it, and the peel you have thrown in the dustbin. Yes or no? You removed the nut, you have thrown that nut in the dustbin. Yes or no? If it is banana, the peel is thrown in the dustbin. Yes or no? Yes or no? So you have removed and you have thrown it. If it is pineapple, how much of the waste will be there outside? When you are chopping pineapple, how much of the waste? So imagine that waste is 20% of 1 kg. Yes or no? Sometimes it can be 30-40% also in case of mango. So you are basically using only 700 grams of mango is used in making juice. 300 grams of mango is in dustbin. Now, when you are billing, you said, Pavan sir, material 100 rupees, labor charge 100 rupees, profit 50 rupees. Please give 250 rupees for your mango milkshake. This big jar mango milkshake you have given. And you said, Pavan sir, give me 250 rupees, Pavan sir. Then I said, oh, hello. Wait. You bought 1 kilo mango. 1 kilo is 100 rupees, but you used only 700 grams, no? So 70 rupees only you have to charge. You will catch my collar and slap me. Have you lost it, idiot? What will I do with that peel and nut? It is normal loss. No one can do anything for that. It is inherent in the nature of the product. You have to charge that to the customer and customer has to pay. This is called normal loss. Are you getting my point? This is called normal loss. Abnormal loss. While making the juice, while giving the juice to you, the glass has fallen out of my hands and it is broken. Then if I say that juice 250 rupees, broken glass 100 rupees, pay 350 rupees to me, then again you will slap me and say it is because of your recklessness, carelessness, this loss has happened. You did not give any juice to me. You are saying the juice along with the jar, the glass has fallen down, pay me money. Why will I pay? That is abnormal loss. Simple. So write down the principle. Normal loss. Normal loss. Include in the cost of inventory because customer will pay for it. Abnormal loss. Abnormal loss. Don't include in the cost of inventory because customer will not pay. Because customer will not pay. Pavan sir, customer will not pay, what to do? Cry. Charge it to P&L account. Cry for 5 minutes. That is what maximum you can do. That is the reason abnormal loss is to be controlled. Normal loss cannot be controlled. This is the concept. If you understand this, and trust me, Accounting Standard 2 did not tell you this principle. This principle is learned somewhere else. Accounting Standard 2 repeated this sentence, which already you know. It is not that, after reading Accounting Standard 2, your eyes are widened and you're like, oh my God. No, this is the concept already you know. Now look here. So in a production process, normal waste is 5% of input. 5,000 metric tons of input were put in process, resulting in a waste of 300 metric tons. Okay. So what is input? What is input? 5000 metric tons. Okay, what is loss? What is loss? 300 metric tons. Loss minus loss, 300 metric tons. So what is output? 4700 metric tons. Okay, but now let us analyze this 300. Will customer pay for this 300? Let us see. This has two components, normal loss, abnormal loss, correct? This has two components, normal loss, abnormal loss. So from this, normal loss is 5% of input, which is 5000 into 5%, that comes to 250. Balancing figure 50 is abnormal loss. Agree with me? So if you do not have abnormal loss, what is expected production? What is expected production is equal to 5000 metric tons minus normal loss 250 is equal to 4750 metric tons is expected. This is called good units. 4750 good units are expected, but because of your inefficiency you got only 4700. That means 50 metric tons is abnormal loss. So that 50 metric tons abnormal loss should be charged to P&L. Okay, now let us read the balance portion. Cost per metric ton of input is 1000. Okay, so what is total purchase cost of that 5000 metric tons? Simple, 5000 tons into rate 1000. Can I say total 50 lakhs? 5000 into 1000, total 50 lakhs. The entire quantity of waste is on stock at the year end. Very good. State with reference to accounting standard AS2. How will you value the inventory in this case? Super. So now look here. Cost per unit is equal to 5000 metric tons into 1000 rupees per metric ton divided by 4750 metric tons estimated value. Total you are supposed to get 4750. So how much this is? 50 lakhs divided by 4750. This is cost per what unit? Cost per good unit. Cost per good unit. Here I'll write cost per good unit. Okay, so take your calculator. 50 lakhs divided by 4750. It is 1052.63. 1052.63 per metric ton. Okay, 1052.63. Now 4000. See, now your abnormal loss to be charged to P&L. To be charged to P&L is 50 metric tons into 1052.63. Correct? Okay, now calculate into 50 metric tons. So it is coming to 52,631. 52,631. So this is a loss you should charge to P&L because customer will not pay for this. This is abnormal loss. You understand? This is abnormal loss. Now what is the value of inventory? They are asking you to calculate value of inventory also, no? Value of inventory is equal to inventory. Now you tell me how many units are there in your hand? You tell me how many number of units are there in your hand? 4700 only, right? Inventory is equal to 4700 metric tons. Why this is moving like hell? This is the problem with the touch screen. 4700 into 1052.63, that is equal to, this is your inventory. 4,700 into 1052.63. It is coming to 49 lakhs 47,361. 49 lakhs 47,369. If you add this to, it will be 50 lakhs. So you have spent 50 lakhs towards material, no? In that 52,631, your carelessness, your inefficiency charged to your P&L. Remaining 49 lakhs 47,369, pass it on to customer. Customer will be happy to pay. That's all. Full stop. Now check the answer. Total value of inventory is 47,368. 1 rupee rounding of difference. Then waste is 52,632. That's all. This problem is also over. Then there is only one more problem to go. Problem number 4. Again common sense. You are required to value the inventory per kg of finished goods consisting of 1. Material cost 200 rupees. Very good. Shall we add material cost in inventory? Yes. Direct labor 40. Shall we add this also in inventory? Obviously yes. Direct variable overhead. Variable overheads directly attributed to production. That is what they mean. Okay. Technically this is wrong phrase. If you are looking from costing perspective, overhead cannot be direct. Idiot, it is indirect. That is the reason it is called overhead. If it is direct, it will become direct cost, no? So how can there be direct overhead? There cannot be direct overhead. Okay, I remember as a student 15 years back, see, this accounts, costing, financial management, you can't even imagine 90% of the problems have been there since ages. Unfortunately, these problems, I'll tell you some books, okay, which this generation kids do not know. There is a book called P.V. Ratnam for financial management. There is a book called Vasishtha Saxena for costing. There is a book called Basu Dasu, accounts. Aral Gupta Radhaswamy, accounts. There is a book called Khanna Pandey Ahuja Arora, costing and FM. Okay. Jain and Narang. So you open any of these books, go to any library which is near to you, take a textbook which is printed in 1980, Can you believe if I say today's ICI textbook or any reference textbook you put, you see more quality problems in the older textbooks, and as it is same copy paste problems. I'm not joking. You try. So this particular question, when I was a student, I asked, sir, what is direct variable overhead? And my lecturer was pissed off in the class. So he asked me, go and ask your costing faculty. But surprisingly, he is the same faculty who teach accounts and costing for us. Chalo, anyway, so it is, a mistake by ICI. There cannot be direct variable overhead. Consider that to be variable overhead. 20 rupees. Can I include this? Yes. Fixed production charges for the year. Above 3 are given per unit. But fixed charges are given for full year. On normal working capacity of 2 lakh kgs is 20 lakhs. Okay. So what is fixed overheads? 20 lakhs. What is normal capacity? 2 lakhs. Can you calculate what is fixed cost per unit of normal capacity? 20 lakhs divided by 2 lakhs, 10 rupees. Common sense. Fixed overheads are to be recovered based on normal capacity. You have studied somewhere. So that is 10 rupees. Now what is the cost per unit? 200 plus 40 plus 20 plus 10, 270. There are 4,000 units in the stock. 4,000 into 270, answer is over. So how do we write? Material cost 200, direct labor 40, variable overheads 20, fixed overheads, in bracket we write total fixed overheads divided by normal capacity, that is equal to 20 lakhs by 2 lakhs, 10 rupees. Total production cost per unit 270. number of units 4000, inventory value 4000 into 270. This is the rocket science you are learning at CA intermediate level. 10,80,000. So what is inventory value? I wish I can become president of ICAI and I will revamp the whole syllabus and will include more practical aspects. But of course, maybe I am little aggressive in giving this statement because the people who are sitting there, like, you know, legends are there like MP Vijay Kumar sir and all these people, they have brains, but you know, there are certain limitations. Even if you want to genuinely do certain things, you will not be able to do. But recently this, academic curriculum for schools and all has been changed, NCERT syllabus from 2020 and all. That is actually a very, very good move. So I was looking at one research proposal between one of the universities from Europe, where UK government is involved, and central government of India, and IIT Kharagpur. These four parties are doing a joint venture: government of India, IIT Kharagpur, government of UK, and there is a university from Europe, from Birmingham. So these four are doing a joint venture on how to introduce innovative thinking in the school curriculum in primary and secondary school sector. Amazing project report. Okay, I was fortunate enough to participate in one of the meetings. In the meeting, I'm like, wow. So probably 5 years, 10 years down the line, things will change. So, God willing, maybe let us expect for the best. But today, this is the syllabus. This is how we need to study. What will happen after 5 years, we don't know. So now look here, 270, 10,80,000, and cash flow statement AS3. The standard is over. Are you kidding me? Now don't worry, not these four problems. In my material I'll give you, there will be 20 problems. But trust me, all the 20 problems you can solve without reading this 10 pages of theory, whatever it is. Now you look at this page number 3.50, where it started 3.38, 12 pages. So do I need to read really the 12 pages theory to understand these four problems? The answer is no. The more unnecessary content you read, the more you'll be confused. And this is not the end. At the end of the chapter, they'll put one box which will give you heart attack. Students are recommended to read the bare standard published by the Institute of Chartered Accountants of India from the Compendium of Accounting Standards compiled by Board of Studies. Are you kidding me? Already I got a heart attack here. And should I read the draft also? That means the bare act also. So these are the problems. So don't worry, take a break. Then we will discuss the theory and we'll do all the remaining problems of AS2 also. But my dear friends, I'm telling you, this is AS2, full stop. The standard is over. But certain discussions, for academic interest and some interesting principles, like for example, in case of work in progress, how will we calculate net realizable value? For example, work in progress, you will not sell, no? See, finished good you will sell. So you know what is the estimated selling price, but you will not sell raw materials and work in progress, no? How do you calculate estimated realizable value? That is an interesting discussion. So like this, some principles will be there, which, out of academic interest as a budding professional, you should know. Those things we'll see, and then we'll solve all the remaining problems also. Before that, shall we take a break?